Macy's falling 7.6% today on news the company is looking to raise as much as $5 billion in debt to ride out the coronavirus pandemic and avoid bankruptcy. And the clock may be ticking for Macy's as well as other retailers. Cowen estimates that Macy's has got only 4 months left before it runs out of cash, while Kohl's, Nordstrom, JCPenney may only have a few months more than that before they're tapped out. So, Guy, this seems like a race against time for the retailers. But if we flip the switch and we open tomorrow, would that change your mind?
In terms of Macy's, no, because the trajectory for Macy's prior to this coronavirus was this direction. Now, maybe we got here faster. Obviously, we probably did. But this just sort of sped up the process, unfortunately. So, no. $5 billion, by the way, for Macy's is not an insignificant number at all. That's a staggering number. The only reason I think to buy Macy's here is you're hoping for a short covering rally into earnings in the beginning of the May. Short of that, I don't see any compelling reason to go plowing into letter M at these levels. I
mean, the market capitalization of Macy's is a fraction of that, right, Tim? A fraction of $5 billion at this point.
Yeah, it's $1.6 billion, I think, something like that today. And you know, I think if you look at the sum of the parts, and you start to weigh some of these dynamics in terms of the asset base, Herald Square is probably worth as much as the asset class. They've got about $5.5 billion of debt today before they do a raise. So that's how investors are doing their calculus right now.
All right, let's bring in Oliver Chen, the senior retail analyst over at Cowen. Oliver, great to speak with you. And you put together that report outlining the various, number of months that each retailer might have in terms of liquidity. And you're also concerned about some other retailers that might be in position to trip their covenant. So if you were to formulate a list of sort of like the poster children of troubled retailers, who would be out there?
Well, unfortunately, we are cautiously optimistic, but what's happening here is the mall is in trouble. We're looking at mall retailers as much more at risk. I think JCPenney's as well. We're watching that. We think Macy's and the liquidity needs. Working capital is a key need. So these retailers are both delaying the accounts payable. They'll also need to purchase goods for the important fall season. And so what we're looking at is really a disruption in consumer confidence and also a transformation. At the same time, we've had a lot of problems in the mall, and mall traffic has been negative. So store closures, co-tenancies, these debt covenants, they're all key risk factors. That being said, China's starting to see some brighter spots. So the consumer is still there. And as we survey consumers, they will come back to retail stores at some point. It's just we're watching consumer confidence, we're watching unemployment, and this transformation happening with curbside pickup, social distancing. These are all huge factors, also unemployment rate. So a lot of variables, but you also don't want to forget Macy's has about $5 billion of real estate, and they also have credit card cash flow of about $500 million. So those are some underlying assets to consider in this distressed situation.
I mean, it's important to look at the balance sheets, Oliver, but as you had said, it's all about the consumer and their ability to continue spending. So let's say things remain shut down almost through the summer, and we're pretty much at back to school, almost near the holiday season, shopping season. Consumers aren't feeling that much better. Unemployment is not improving too much. How do you then foresee the future for some of these department store retailers?
It'll be very problematic because about 34% of the EBITDA is fourth quarter, and the months get very critical, especially back to school, August. School is transforming. So what happens with teen retail? What happens with denim and those needs? And then the holiday selling period is where retailers make all their money. So these capital raises are really essential. And there's no doubt we'll have filings and we'll have bankruptcies, and that will spiral. As we get closer to July, August, these are big issues. The other big issue is what if we have openings and closings? That is going to be extremely painful because clothing and apparel is a lot like food. It really expires quickly, and that'll be very disruptive to manage as well. And keep in mind, on the other side of this, tons of promotions. So we're recommending Costco, we're recommending Target, we're recommending Walmart, and we also think beauty. Beauty's been a resilient trend. So beauty's been essential for some customers, and so the online trends at retailers like Ulta, that being off mall, are more positively positioned.
I saw your note about Ulta, I think it was last week or so, and their balance sheet was surprisingly strong.
Yeah, it's in a good position, Ulta. I think, furthermore, the online trends even accelerating as people really think about skincare, hair care at home, and the essentials that you need in beauty. And that's a great long-term business model with a very good loyalty program, a very good online interface, and mass plus prestige. It's a concept for the future, for the long term, and furthermore, it's off-mall. So we're generally much more positive on off-mall. And keep in mind, as we look at this event happening, there'll be market share gains with pain. So JCPenney has lots of beauty, Macy's has lots of beauty, and it's been tougher for them. A player like Ulta can gain share, and beauty has been a resilient industry. As you think about the recession, how do you play stocks in the recession? The lipstick effect,
Right.
and really thinking about lower access price points as well. So there's a thesis there in terms of being interested in that name in the recession, in the context of the recession, and that's something we're thinking about for clients and investing as well.
Oliver, thank you. Oliver Chen of Cowen and Company. Grasso, you like to go for best of breed here.
Yeah, so Costco and Walmart are best in breed in this space. And just think about it. Costco has built its world around bulk buying way before coronavirus. And I think that people's behavior has changed. And I don't think they're going to stop bulk buying after we even come out of this. And then you get the kicker of the membership rates, and the renewal rates on membership are off the charts. It's an annuity with Costco. Walmart, I would like to be there as well. It's up 10% year to date for all the obvious reasons. They're very strong e-commerce, so I don't think you can go wrong either way. The other one that's been thrown out, though, Target, down 16% year to date. Maybe you could bottom fish a little bit there because I think they're a strong brand. They will survive. But all of these names, you want to think about who's going to be best coming out of this and whose behavior is not going to change. And I'm going to throw one more in there. Amazon, we think about it as the everything stock, but think about Amazon Pantry. How many people are getting stuff on a regular basis, delivered monthly now, that never did that before, me included, and they're not going to cancel that. You have Prime Video, you have Prime Music, that's all shelter-in-place stuff. And don't forget, AWS was the original catalyst to the Amazon story. Cloud is more important than ever with shelter-in-place.
I feel like if you open that door that's behind Grasso, you're going to find dozens of rolls of toilet paper. Talking about bulk buying. Guy Adami. When we say best in breed, we're talking about the ones that have held up, though, like a Walmart, which is basically at highs. So how do you wrap your head around valuation there?
Well, you can't. I mean, that's been my concern all along about Walmart. It's just expensive, and what I've said for a while, incorrectly, correctly, that if you like Walmart at its valuation, you got to love Target. I mean, I find Ulta interesting because, you know, people like me are going to flock there for our Grecian Formula 17 or whatever we use for the little grays we get during these times, as you know, Melms. But in terms of best of breed, is that the one, Just for Men?
I don't know, the one you comb in.
Oh, whatever. I don't have any, as you can tell. You know, it's funny you mentioned that. You could tell that obviously I haven't used it in quite some time. But what I will tell you is, and something we've been steadfast, and if you recall the game we used to play of, what's that thing we called that, the power pitch? Many moons ago, we talked about this little company called Dollar General, and that sucker continues to go higher. So if you want to be in retail, I think DG is the one that gets you done, Mel.